Thank you, Deputy Speaker. Deputy Speaker, it's time to take stock of not just Australia's, but the global structural economic imbalances that leave ours and many other countries economically vulnerable to shocks. The reality is that complacency has exposed the world to incredible financial instability. That should make everybody mindful of the circumstances and the times in which we live. Global debt has recently hit a new high of 337 trillion Australian dollars. In combination with excessive quantitative easing following from the global financial crisis, particularly in the United States, but other countries, globally low interest rates that have been held stubbornly low in many markets for long periods of time, and that includes our own, questionable banking frameworks and regulatory environments, as well as, of course, the vulnerability that has come from recent outbursts in trade wars, although that looks thankfully now to be stabilising somewhat, and of course political volatility in countries that one should be able to depend upon. There's no single red flag. There are multiple triggers in the global economy today. There are plenty of signs that there are reasons why we should be concerned, not out of an obsessive pursuit of fear, but out of a mindfulness and cautious position to make sure that as Australians we can be confident that we are in the best position to weather storms. Look at the signs. There's Turkey's economic and political turmoil. Of course, as I mentioned before, the risk of a Trump trade war with China, which seems to have eased somewhat, or at least there's a truce, but could easily flare up again. And of course, the ongoing tension that sits between the European Union and the United Kingdom around their Brexit deal, which is facing very difficult challenges and could have significant economic impacts across the continent, and of course, the financial stability of the United Kingdom. But we also have more serious concerns. Unlike Brexit, there's the Italian debt crisis, which has the capacity to send the euro into collapse if not handled properly. Still wounded from Greece's debt crisis, Italy's fiscal mess is starting to epitomise all of the fundamental flaws of the eurozone, where debt is used simply as a vehicle to finance and resolve problems for today, without looking at the fundamental and deeper structural challenges that the mad pursuit of social democracy takes you to, where people are dissuaded from their enterprise, their ambition, they're anaesthetised to the challenges of life and the capacity need to adjust to changing circumstances, instead in favour of dependence on the state, because at some point the buck stops with somebody who has to pay, and when you suck the life out of your private sector and those who pay tax, it will only have a long-term negative effect. At 132% of GDP, Italy's total government debt is frankly shocking and frightening, especially as Fitch Ratings actively considers higher risk premiums for that debt. And when facing economic turmoil, debt is of course the great multiplier by its nature. That's the whole point. Debt is merely the extrapolation of security. Bond markets are restless as Rome pledges money it doesn't have to fulfil populist policies and promises. And if Italian bonds are downgraded, individuals, families, companies and financial institutions will feel the tremor all across Europe. But the truth is, it will go across the globe. And monetary policy interventions are no silver bullet at this time. The European Central Bank is already trying to wind back an exhaustive quantitative easing portfolio, meaning an injection of extra liquidity into Italy's banking system isn't likely. But we also need to be honest about what happens when you have quantitative easing. You borrow from the future to pay for today. You steal from future generations by propping up the value of assets, making them further out of reach of those who are not a part of the asset-owning class, to protect those who do. Quantitative easing is theft. It is theft from the future and from the poor to prop up the rich. It is morally wrong. And this will be much worse than Greece. Italy is the currency bloc's third largest economy and accounts for 11% of the EU's gross domestic product. That's big enough to inflict collateral damage internationally. Now, unfortunately, some other countries don't learn these lessons. And let's look at ourselves. 10 years ago, when the sirens were sounding, Australia had a healthy budget position. In fact, we weren't just in surplus, but we had net savings after a long period of economic growth and economic structural reform. We had more flexible labour markets and strong foreign demand for our mineral resources. Lower interest rates and a major exchange rate depreciation insulated us from harm during the global financial crisis. Flexibility for the Reserve Bank delivered. High mineral prices delivered. That should have been the focus with tax reform to get Australia through. Instead, we had an excessive focus on stimulus by the Australian Labor Party, and we are still carrying the burden, the debt that comes with that today. And of course, it's meant that it's been harder to fund services we want to provide while we've continued to service that debt. The truth is, we're in a more difficult situation than we were when the crisis started. We were then, and it's continued to go now. In practical terms, it has to be the case, particularly because we know where the growth and spiral and increase in spending has gone as a direct consequence of the challenges of an ageing population. That means the time for prudence and responsibility is now. It, of course, has been now for a while, and the Morrison government will be delivering the first budget surplus in a decade next year. And it's a great achievement to be able to put this country on more stable financial circumstances. But let's be frank, if we had have had more cooperation from our political opponents, we might have been able to get there earlier. In the past 20 years, the household debt-to-income ratio has doubled and now sits at almost 200%. Australia's net debt is at 1.004 trillion in September. We have other challenges. A significant dependence on the states on stamp duty. The Commonwealth is heavily dependent on income tax as the basis for its revenue base. And of course, we have high leverage as a consequence of house prices, directly associated with low long-run interest rates. And frankly, the biggest risk we face today is the election of a Labor government. What we need to do is be prudent and responsible in working through the structural challenges this country has. We need serious tax reform. Serious tax reform. And yes, political opponents across the other side of the chamber said we need to take the debt seriously. We are. We're delivering a surplus. But more critically, what we need to do if you want to deal with the debt is you actually need to cut spending. And those are two words that you'll never hear utter out of their mouths. Instead, what we have is an obsessive focus on trying to raid the savings of retirees, a new tax when people lose money, which is pretty extraordinary when you think about it, and a focus around dissuading people from investing in markets for fear that they'll be taxed excessively and disproportionately to their investment. US demographer Harry Dent accurately predicted the 2008 crash, and of course we've seen recent events on the markets and many of us are questioning, is this a moment that's a precursor to something greater? Certainly there's been many predictions that property prices could drop significantly, between 40 and in some cases 50%. The question for us now is what we do, not just as a parliament, not just as a government, but as a nation. The time for prudence and responsibility is now. The time to drive tax reform to improve this country and broaden the base of our tax system to make it sustainable is now. If we don't, we raise very serious challenges about this country's long-term economic security.